When I first started day trading over 7 years ago, I quickly realized how easy it was to make mistakes that could drain my account. Through trial and error, and by helping hundreds of other traders along the way, I've identified 5 common mistakes that often lead to failure. I'm sharing these with you, not just to highlight where I went wrong, but to help you avoid the same pitfalls. By the way, if you are looking for a reliable broker with very low deposit requirements and quick withdrawals, see the links in the description box below. The first major mistake I made, and see countless others make, is not having a solid trading plan. Early on, I would dive into trades without a clear strategy, treating my profit and loss (P&L) as my only measure of success. But trading is a business, and just like any business, it needs structure and consistency. Over time, I learned the importance of having a comprehensive trading plan that includes pre-market analysis, specific active trading times, and a post-market review. I also made sure to clearly define the instruments I was trading, the capital I was using, and the risks I was willing to take. This plan became my roadmap, guiding me through the chaotic world of day trading. Another big mistake I made was over-leveraging and over-trading. I remember those days when, after taking a loss, I would desperately try to make my money back by jumping into more trades. This would often lead to a downward spiral where I would overtrade and end up losing even more. It was a tough lesson, but I eventually learned to set strict limits on how many trades I would take in a day. For those of you who struggle with this, try reducing your trades to just one a day, focusing on quality rather than quantity. Emotional trading was another challenge I faced. There were times when I would make impulsive decisions driven by fear or greed, and those trades rarely ended well. I had to teach myself to trade based on logic and a systematic approach, rather than emotion. Now, before I take any trade, I make sure it aligns with my trading plan and has a high probability of success. I've also learned to avoid the temptation of taking random trades just because the market suddenly gets active. Instead, I focus on setups that I've carefully refined over time. Speaking of setups, I can't stress enough the importance of having a playbook. When I first started, I didn't have a clear set of strategies to rely on, and that led to taking a lot of low-quality trades. But over the years, I've developed a playbook, a collection of high-probability setups that I know and trust. Combining these setups with my analysis of price action has made a huge difference in my trading. If you don't have a playbook, I strongly recommend creating one. It will give you the confidence to approach the market each day with a plan. Lastly, I've seen too many traders, myself included, fail because of unrealistic expectations. When I started, I had visions of turning a small account into a fortune overnight. But the reality is, that kind of mindset is not sustainable. Over-leveraging a small account in hopes of making massive gains is a recipe for disaster. Instead, I learned to focus on consistent, modest returns. For example, aiming for a 10% monthly return on a well-capitalized account is a much more realistic and sustainable goal. I also found that leveraging prop firms to diversify my trading portfolio helped me grow my capital steadily over time. If you are looking for a reliable broker with very low deposit requirements and quick withdrawals, see the links in the description box below. By sharing these experiences, I hope you can learn from my mistakes and approach trading with a more disciplined and structured mindset. Trading is a business, and like any business, it requires careful planning, consistent execution, and continuous refinement. If you can avoid these common mistakes, you'll be well on your way to becoming a more successful trader.